All right, everybody, welcome to CyberBulls. So we have a special guest today. His name is Nicholas Colas. He's a 30-year veteran of Wall Street, has tremendous experience in auto industry. He currently runs DataTrek Research. He's regularly on CNBC and Bloomberg. So Nick, Tesla and the investors of Tesla, it seems to have quite a high percentage of retail investors. Have you ever seen an animal like this? Is that a good thing or a bad thing?
Oh, I have seen it before, but not for a long time. I'll tell you, I was covering the auto industry in the 1990s, and a couple of stocks back then had kind of similar investor profiles, but they weren't the ones you'd expect. One was Cooper Tire, just a tire manufacturer based in Ohio, very similar to Goodyear, except they only sold aftermarket tires, no OEM tires to car companies. And the other one was a company called Eklund, which made aftermarket parts. And those two companies had very strong retail investor followings, extremely strong, virulently strong. As a matter of fact, I got my first death threat on Wall Street when I put a hold on one of those stocks instead of a buy. And this was all pre-internet, pre-even any kind of communication aside from voicemail. So I walked into the office one morning after I put the hold on Cooper Tire, and several death threats. Very, very pointed. So retail investors do get very involved in their stocks, but I haven't seen anything like that really until Tesla in the last couple of years.
Okay, so then. And then the percentage, Alexandra, you did quite a bit of work here. Do you want to compare it to the other car companies?
Yeah, sure. So I think the most surprising is actually GM, because GM has 85% of its float. I mean, most of it is float because there are very few insiders there, held by institutionals, only 16% retail. That's actually why the credit rating of GM is such an interesting point, because they may leave if ever GM loses their investment grade rating. Ford is 56%, Rivian is 63% institutionals, and obviously Tesla is about 43, 44%. So in Tesla's share, we have about the same share of institutions than of retail investors, 43, 44%, and then the rest are the insiders, mainly of course, Elon. The other thing that's interesting is the institutionals that hold Tesla. We just had the new 13F filings, about 3.5 thousand, while for GM, it's about half of that. So it's less, and they hold more. Ford is about 2,000, Rivian is about 826. So the funny thing is, there are more institutions holding Tesla, but they hold less of it. And it just, for me, it shows the prudence these people still have. The apprehension they have of Elon, of Tesla, will this all work? And I think it's a good basis to start our discussion.
No, it is interesting and I think the point's absolutely right that a lot of institutional investors still feel very wary about Tesla for valuation purposes or for key man risk purposes, or just not really understanding or being comfortable with the story. It's very different from the companies I mentioned before. They are much more prosaic businesses. They just happen to have a loyal fan base because people understood the business, understood the product. In many cases, either worked for the company or knew people who did. And so there was a level of comfort there that they understood what the fundamentals of the business were. And I think in that respect, the Tesla story is somewhat similar to those stories from 20, 30 years ago, in that the people who own it, the retail investors who own it, really truly understand the story, and in many cases do the kind of work like watching your channel or reading about the business, understanding the technology, that gives them a lot of comfort with the story that institutional investors might also do. Then they get wrapped up in valuation and PE ratios and what is this stock really? Is it a tech stock? Is it a car stock? What is it? And they kind of get lost in a bit of the minutia and don't see the story at the 30,000 foot level that a lot of retail investors clearly do.
One of the questions we've been asking so often with so many people is, how do you get the institutional investors to, step up and start investing? And then when I said that question, Alexandra, you said, why do we even need that?
Well, I still think that. I mean, the first thing is, people get uncomfortable with Elon. We've seen it again this week, right? He says something and they blow up. I mean, we've lost one of the institutional investors this morning. So the issue also for an institutional investor is that their time horizon is just much shorter. When you're a fund manager, you're measured against other fund managers. You have your yearly bonus that's linked to your fund performance. You don't have the time that a retail investor has. A retail investor's principal currency is time. If you, as a retail investor, have 5, 10, 15 years ahead of you and you see a stock and a company and believe in the vision, Nick explained it very well, what does it matter whether it arrives a year earlier or a year later? For a fund manager, it is important. They have their benchmarks. They have committees they have to report to. They have investors they have to report to. So it's just a completely different mindset, a completely different approach. Now, with that comes that institutional investors have the same voting powers than retail investors. So at the moment, like I said, Tesla is about at the same level. What happens when institutional investors vote? You have these voting advisory firms. I don't remember their names anymore, but there are 3, 4, 5 of them, and they collect usually the votes for other institutional investors because these fund managers don't want to sit through annual shareholder meetings and papers and go through. So there are advisory firms that go through them. So usually you have a consensus in there. You have a couple of key people that manage these votes, while the retail investors obviously are spread over thousands and thousands of them. And so you actually have, if they have a higher percentage in the stock and are as concentrated in their opinion building, you have a risk that they overturn things. They find the key man risk too high, or they find certain decisions too controversial, and they could have a real weight on them. So I think for a stock like Tesla, where retail investors seem to be able to stomach so much more, it's actually at the moment a good thing that institutions stay a little bit put.
Yeah, that's entirely fair. I mean, the goal of any company, any public company, is to have a very stable, very sticky base of shareholders that understand the story and are willing to put up with quarter to quarter, even a year to year volatility. It's very hard to do in the institutional community. It's very hard to convince an institutional investor to stay overweight a name or to be long a name for years on end, no matter what. And it ends up being a very challenging situation for a lot of public companies because they don't know why institutional investors have bought or sold their stock in a given quarter. And there's a whole sub-industry in investor relations that tries to explain that. It's virtually unexplainable, however, because there's so many decisions that go into the professional portfolio manager's life that create buy and sell orders on a trading desk. And so it's much better to have a stable base of investors, in this case retail, that really buy into the story and can eat through that volatility that might happen in a given year. And I think it's also worth noting that because Tesla's up so much over the last 5 years, there is a lot of credibility, a lot of comfort among retail investors because they've seen the money-making potential of the ideas, and they're willing to write out the volatility because they've seen it work for so many years in a row and for so long. And so that gives them comfort and some patience as well. It's a very different story when a stock begins to implode, by the way. And I've seen that happen many times, particularly in the auto industry, where the company might have 1,000 fans when it's running at 100 and no fans when it's at 25. And obviously the reverse should be true, but that's the way human psychology works.
Yeah, we saw that a little bit in Q4 2022, right? I mean, people got margin called. The whole Tesla story got a little bit more shaky. People had positions in options, did stuff that they thought would work forever, and then got caught into it. So that is obviously the problem with retail investors. The other thing I do believe is there are institutional investors who just firmly believe the price today is too high. Right? If you don't believe in autonomous driving, we'll get to that in a second. Probably at a 750 billion valuation, you have stomach aches before you want to get into this stock. While and they don't often are not thinking cross-sector bots and dojo and whatever else, right? And so it's just a completely different animal. You said it right, Nick. It's a completely different attitude. And it, sometimes I even think that Elon pampers retail investors, and I mean, you may find this a strong word, but pampers retail investors because he wants them to stay there, and he doesn't really invite institutionals. I mean, his behavior in those earnings calls certainly doesn't help to create goodwill with these institutional investors. So, and sometimes I just think, my gosh, here's doing it again, and then comes out a tweet where he says, only retail investors understand me, or he comes at the shareholder meeting and thanks to retail investors in particular, whatever. And sometimes I think maybe he's actually playing a 4D chess here.
So Nick, I've got a table to show you. And it looks like, as a retail investor, my question is this an opportunity? Because eventually institutional investors might actually buy. So if you look at Tesla here, not only is it one of the lowest of the Mag 7 here of percentage of funds owning Tesla, but it's also the lowest in weight in their funds as well. Now, as a retail investor, I go, that's great. That means that at some point they're going to come flying in and just come back up and they're going to have to catch up. They might have to buy Tesla. They'll be forced to buy Tesla at some point. Is that logical or not?
It is fair. The one thing I'd say is a very interesting table, very interesting chart, is when that Tesla dot moves into the upper right-hand quadrant, maybe be time to start lightening up on Tesla because finally, the story will be done and the story will be understood. This could be 3, 4, 5 years down the road when it becomes a much larger, maybe more prosaic company, and the opportunities aren't as massive as they are today. So I'd say it's an excellent table, it's an excellent chart for right now, and it should move up into the upper right quadrant. But when it hits Amazon, Microsoft, Meta levels, maybe it's time to start finally lightening up.
Yeah. I mean, do you believe Warren Buffett will ever get into the stock?
Ah.
That's a great idea, a great question, because I never thought he'd even buy Apple, and he finally did. Maybe a decade too late, but he's there. And it's become a huge part of the portfolio. So I think Warren likes to see things proven. He's not a big investor in technology per se, and certainly not in very forward-looking technology. So maybe with time, we'll see how much more time Warren has.
True. And maybe his next generation generals may be a little bit more open.
Perhaps.
It's funny. I mean, I agree with you. He definitely likes to see things more proven. But I was actually, BYD was one of my suppliers in the mobile phone industry. I was actually there in Shenzhen sitting with them and with the leadership team when they actually received word that Berkshire was actually investing in them. And they were, they kind of used it as their, as an advertising tool to try to even get more clients on the smartphone side. And that was pretty early, and they were investing on the EV side. They were really investing on the components business side. But yeah, I do think he wants to see it be a little bit more proven. I was going to ask you, Nick, about just as I look at the auto industry and I look at what's happening right now, and there's this conversion happening in propulsion systems and really how cars are being made. And one of the things that I track very closely with my background is just supply chain and supply chain performance. And I actually do think, and I've listened to some of your work, and I do agree that part of the survivability or thriving in this industry is going to come down to supply chain. And it's something that's probably talked about the least amount. Everybody wants to talk about the product or the propulsion system or the CEO or the UAW, but like there's this underlying thing called the supply chain that defines a lot of the cost structure and the ability to scale. And when I look at supply chains, it's definitely, I've not seen a supply chain really in any industry that is structured in the way that Tesla is structured in terms of how flat it is, how few layers there are in the supply chain, and how vertically integrated it is. And they're not only vertically integrated in terms of componentry, but they're vertically integrated in terms of how they develop product, meaning that it's under their four walls and in their control. So as you think about supply chain and really how the, like where you see the auto industry going, how does that factor in to your analysis? Because I don't really hear a lot of analysts talking about supply chain and supply chain performance as it relates to the auto industry.
Yes, it's a great point. Just maybe a little bit of perspective and background on this topic before we kind of get into the present day. The supply chain in the auto industry has historically been extremely complex, mostly because the production process is complex, the design process is complex, and it happens years in advance. So the car that you see running down the road today is a new model year 23, 24, was designed 3 and 4 and 5 years ago in most cases. And suppliers had to be involved all the way through the process. If you go back in time, say the early 1990s, the supply chain management process was very different among the big three, for example. So GM owned 75% of all the supply chain inside its four walls. And this, they felt, gave it a lot of flexibility and a lot of design features because they controlled the production process all the way through, basically from raw materials to the end product. Where Chrysler, because it had been financially under distress for so long, was only 25% inside the four walls. And it turned out that 25% process, which really was enabled and really Toyota was the first to really figure it out in the 60s and 70s, is a much better process to use. because you own less capital, which is a key part of the auto industry. You don't want to own a lot of capital. You want to assemble the car, brand the car, market the car, and service the car, but you don't want the intervening supply chain to be part of your capital structure. So getting that off your balance sheet is hugely helpful. So that's the background. The auto industry learned that vertical integration within the four walls of a company was very suboptimal. And so they ended up understanding that the right way to go about it was to have a few key suppliers. But then they kind of made the mistake of not only having what they call tier one suppliers that fed up to the assembly plant. That's what the definition of a tier one supplier is, somebody who supplies to the assembly plant. They had tier two and tier three, and there were even tier four suppliers. And so there was just as much complexity in managing that process as there might have been even if you owned it all. And what you've seen over the course of the last, say, 20 years, maybe 10 years, is trying to make those layers, as you said, a little thinner so there's not so much complexity all the way through. And one of the big potential benefits of EV production versus internal combustion production is that it can be a much simpler supply chain. And that means faster working capital turns, better financial performance, and ideally a better product because there's less complexity in the product. So a more stable, more durable product over time as well. So the arc that you kind of alluded to has been in place for a long time in this industry. And I think the move to the new form of propulsion to electric vehicles will give us finally that one very clean supply chain process that we've been lacking in the industry literally since the 1910s and 20s.
Yeah, no, I appreciate just one more quick follow. That's going to be pretty dramatic. I mean, there's a tremendous amount of capacity and number of suppliers in the industry. I think if you look at Europe, the U.S., I think even China, there's a lot of excess capacity sitting around. So I think it's going to be a pretty dramatic transition as it happens. And I just one more quick follow up is, how do you view this GM, Ford, VW kind of stepping back on EV? And I view it as, from a supply chain perspective, I view it as like they're going to be crushing their EV only suppliers. And then even when they come back, I don't even know what form the OEMs are going to come back in when they try to re-ramp up, and where those suppliers would be even if they would even exist. What are your thoughts on just that start and stop and what kind of impact that could have?
Yes, it's a wonderful point and super important. Just the overcapacity you alluded to in the supply chain is even just as prevalent in the end manufacturer, the OEM, the car manufacturer. There's 40% global overcapacity for internal combustion engine vehicles, and this has been the case for 30 years, as long as I've known the industry. There's just way more capacity than there is demand, and so you end up with this perennially low margin structure, which is why you end up with low valuations for traditional car companies. Your point about suppliers is equally important, because the hardest thing about being a supplier to the OEMs is you don't know their plans, and even if you hear their plans, you can't necessarily trust them, because they're subject to cyclicality, product changes, and in this case, changes to how they're thinking about moving from internal combustion to electric vehicles. And so, while you have the benefit as a supplier of dealing with multiple OEMs potentially, and it's kind of sharing and getting rid of some of the market share risk that's inherent to being a supplier to one company, you have the offset that you have to dedicate a ton of capital, which is very difficult. And then you have to plan for that capital utilization. And when your key customers step back, you got to really stop and think, okay, what do I really want to invest in terms of future production? Because this might not really materialize for now 5 years instead of 2 or 3 years. And it's very disheartening to a supplier. And as I think you allude to, it really damages the trust that's really necessary between the OEM and the supply chain to make production happen the way it should.
Yeah, agreed.
So I've got a question for you, Nick. One of the big questions that many of us who are both investors in Tesla and not yet investing in Tesla is, what is the valuation of this stock? How does this stock behave? You had this fantastic research that I want you to share with the audience here. You have your company called DataTrek Research, and you produce this newsletter. Thousands of investor professionals subscribe to your newsletter because you do incredible research. So the one you shared with me just last week was pretty brilliant. You went and took a look and said, okay, what is Tesla? Does it behave like an auto company? Does it behave like a tech company? Does it behave like a large cap company or an energy company? Please share the results of that research you did.
Sure. Well, actually, you can share some of the credit because I got the idea after our first interview. I began thinking, okay, how do we think about this in structural statistical terms? And it's fairly straightforward to do. What you do is you take Tesla's stock price and you look at the day-to-day returns, up or down, 1%, whatever it is, and then you line that up with a sample. So in this case, let's look at Tesla versus the S&P 500. And what you find when you line up those two return profiles over a year is the correlation basically structurally is around, and I also use correlation and what we call R squared or causation in kind of similar terms. But Tesla basically behaves about 25% like a large cap stock. It also behaves roughly 25% like a large cap tech stock, Apple, Microsoft, that universe of companies. And so what we find is that Tesla is a typical large cap stock. It trades kind of like a tech stock. It trades with the market, but 75% of how it trades is not explained by what the S&P does that day or what the tech stocks do that day. So it's kind of its own beast, which we kind of know and understand. So totally fair. Then I looked at, okay, does it trade like an auto stock or like a clean energy stock? And so I use GM as the auto stock comparison and ICLN as the clean energy comparison. Big ETF owns a ton of clean energy names, ironically not Tesla. And there the correlation R squared is like roughly 17 to 18%. So it doesn't trade anything like an auto stock. And by the way, Ford and GM's correlation is like 65%. So auto stocks do trade pretty similar, but Tesla doesn't trade like those. It also doesn't trade like clean energy, which was interesting because I thought it would. And then lastly, I thought, okay, maybe just Tesla, because it's a huge valuation stock, trades in line with with long-term treasuries, 20+ year treasuries. So I lined up Tesla's returns with the TLT ETF. And there the correlation's 1%, literally basically zero. So Tesla and long-term interest rates have nothing to do with each other. So kind of in summary, it's a statistical way to explain what I think we all intuitively know, that Tesla trades on its own fundamentals and isn't a car company, isn't a clean energy company, isn't a call on rates. It is its own animal, and based on all the fundamentals we discussed today.
Wow. Brilliant.
Has a higher correlation with a certain stock, like for example, Nvidia. I mean, I did see that it's not like GM, that no doubt about it, but among the large cap or large cap tech, is it rather like an Nvidia or is it rather like an Apple, or is there absolutely nothing?
There's just nothing there. It's very much on its own fundamentals. We looked at some other variables, but wanted to keep the analysis kind of simple for our readers, and that was the sum total. Was this is its own thing?
It is, right? That's why we love it, and that's why so many people hate it. No doubt about it. I wanted to ask you a much more general question. Are we in a recession or not? Because I mean, we talked a little bit prior to that. We're all not young. Obviously, Jeff is young, but I'm not. In 35 years of looking at this market, I've never seen a situation like this one. I mean, of course, we never came out of a pandemic before either, but this is so weird between inflation, consumer behavior. I don't find anything logical in today's situation.
Yes, it's a very good point. There is no doubt that for a lot of people, this feels like a recession, and for a couple of reasons. The first is that there was a lot of fiscal and monetary stimulus put out to fight the economic effects of the pandemic. So in 2020, a lot of checks went out, low interest rates, people locked in very low mortgage rates, companies locked in very low borrowing rates, a lot of money flooded the system, and that created a sense of well-being, which was necessary against all the fear people felt around the pandemic and what came afterward. A lot of job losses, a lot of concerns, a lot of families in real trouble. As things have normalized, even though people generally are employed, generally have gotten some raises, inflation really ate into consumer confidence dramatically. And there was also this hangover effect of no longer having those stimulus payments to lean back against to help offset the pain of inflation. So even though the numbers look good, I think for a lot of people, they don't care about the numbers. They look at their real lives and see food expenses still going up, see their rent going up, and don't see their wages keeping up. So they may have jobs, they may have some savings, but they're dipping into credit cards now a lot more to make up for what they're not making in wages versus inflation. So consumer confidence is not great, as you all know. And I think that that is a function of what I've outlined. It's a combination of some kind of comp effect and the very real pressures of inflation that are still present today, even though the numbers are coming down. So it's not a technical recession by any means. We don't have really rising unemployment. We don't have negative GDP growth. But I think for a lot of people, it feels that way. And I think that's a major overhang for a lot of investors, a lot of consumers, a lot of Americans generally. And I totally see it in the data and in the credit card data as well. But technically speaking, we're not in a recession. The stock market's saying that we're going to have probably a short recession in the first half of next year. That's pretty evident from the drop off that we had from July through the October lows. We're seeing a bit of a snapback now because the market's saying if we do get a real recession, higher unemployment, negative GDP growth, it'll be fairly short. It'll be out of it by the back half of next year. So we could have a technical recession pretty soon, but I think for a lot of people, they already feel it. They already feel a recession is here, even though they've got jobs and a place to live and can put food on the table. They feel those stresses, and it's super important to how they view the economy.
Do you believe and agree with Elon when he, in his earnings call, he makes a really big deal that's saying that interest rates is why, car prices are actually higher than you realize. We need to cut prices. Other people are saying you are just blaming the economy when, you can cut prices and we don't see price elasticity, growing volume. To what extent do you agree with what Elon is saying there?
Elon's right. It's no other way to put it. That's a very accurate point, and it's one that automotive CEOs have made since I started looking at the group in 1991. Interest rates are a really important component of how people think about durable goods purchases, cars, houses. It's a super important part of it. So when rates go up, the monthly payment goes up, whether it be a lease or finance to buy, and that's a very real part of the equation. So he's absolutely right.
Okay. I got a fun question to ask you. Okay. So, you're an expert in auto industry. You've helped Chrysler out of bankruptcy. You've helped many automakers go IPO, and you've been deep in their executives. So one of the questions the three of us here on this panel have been talking about is we're pretty bullish that there can be some kind of partnership, right? We've heard all sorts of supercharger partnerships where eventually all these legacy auto had to be forced to partner with Tesla, not only in the US now, but also in Europe. And China, I mean. And then we've got these oil and gas companies that are partnering with Tesla for the superchargers. But what about other things like software, full self-driving? Some people think batteries or drivetrains. So your knowledge of these legacy autos, how likely will they partner with Tesla in the very near term, like this year, 2024?
Oh, I tell you, I mean, the auto industry is a little bit like, what Winston Churchill said about Americans, which is they'll do the right thing after they've exhausted every other option. And that's pretty much how it goes with the auto industry.
Yeah.
They will end up doing the right thing when they are forced to do it, but there's always a pride of ownership in this industry where they want to try to do it first by themselves. And then they'll try to do it with a consortium of maybe like-minded partners. And there's examples of this in manufacturing. For example, GM and Toyota co-ran a plant in California for many years because GM wanted to learn from Toyota how to do this Toyota production system. And eventually that joint venture was dissolved. And that plant is the Tesla plant in Fremont.
Yeah.
So that is the history of that plant. So it's sort of that one plant, I think, is emblematic of how the auto industry works. They'll try it themselves. They'll try it with partnerships. Then they'll give up and somebody new comes in and does it right.
And so do you think those first partnerships are rather going to be with Chinese providers before they would consider Tesla as a tier one, or even as we considered Tesla being an OEM tier 0.5 provider, right? Because it would be at a very high level.
The short answer is yes. That's certainly an opportunity for Tesla. The question will be, how bad off do the traditional automakers have to be before they'll accept that? Because history says they've really got to have their back against the wall before they do something really, really dramatic. GM's history is replete with many examples of this, going back to the Toyota partnership I discussed, but also automation and robots in their factories in the 1980s. They'll either stumble along, or they'll try to make an end run and just go super fast. Neither way is particularly effective, and then they end up doing the right thing last. So as long as Tesla keeps building out the platforms for charging, for manufacturing, all those other features, it becomes a very rich option set for them to sell those technologies to the traditional OEMs when they find they can't do it themselves.
Volkswagen is a good example in that case as well. And I don't think it's actually a surprise that Volkswagen is currently doing investments in China, partnerships in China. GM, you're right, is doing I think it's called SAIC partnership there in China for electric cars. So I think they're really trying out everything else before, hoping that any of those newer Chinese partners will bring them the solution before they have to knock on
Can
the
you
door.
explain that? Nick, can you explain why would Stellantis partner with SAIC in China? What is it? Volkswagen partner with Xiaopeng. Why are they making these investments in partnership with the Chinese automakers instead of Tesla? What's the difference? I know there's a big difference, but
yeah, I mean, there is a big difference. The short answer is the auto industry has always been focused on reducing manufacturing, quote, variable costs, how much it costs to make a vehicle. And they view China as a low-cost source for vehicle manufacturing. And so their first go-to move will always be to go to China and try to joint venture factories and figure out how to do production processes more cheaply there. And so it's not just for the technology, I think it's also for the access to a lower cost manufacturing base.
okay.
Now, if I recall it right, you discussed with Herbert that you visited the BYD showroom in Paris and saw that car. And I found that very interesting because while I only follow it at distance, they got the 5-star safety rating. That doesn't seem to be horrible reviews about their build quality. It seems to be still, products in motion, but they seem to catch up quite quickly, these Chinese cars. I mean, obviously, it always looks nicer on glossy pictures than it may be in reality. But do you consider China actually close to catching up with Tesla on tech, on soft and hardware, or is there still a big gap?
I think there's two still relatively large gaps. The first one is the build quality is okay. And, you can get very geeky about when you look at a car to decide how well it's constructed, like panel widths and things like that, or the quality and touch and feel of the materials inside, what the headliner feels like, what the leather feels like. All of these things that kind of subliminally end up creating a buyer impression about which car is better than the other car. And on that count, the European manufacturers, which are priced comparatively to BYD, are still better. American car companies perhaps more on par, but the European car companies still better. Very, very good attention to design and materials and fit and finish and things like that. Where BYD and every car company still faces a challenge versus Tesla is just simple branding. When you think of an electric vehicle, still Tesla is the brand people think of. And it takes a long time to build that brand. And there's also some first mover advantage to having a brand. And so while they might have the right product at the sort of the right price, and with most of the right features, there's still just the issue of getting somebody to say, yeah, I'll take a risk with $70,000 on a car company that's out of China that I've never really seen before. And it just takes time to get people comfortable with the brand.
Especially if the Tesla is $70,000 as well, or is price not an argument for these buyers?
Oh, price actually comes down to, and I saw this in the BYD showroom, price is usually a monthly payment phenomena. So as long as your monthly payment can be about the right level, call it 600 euros, you'll get your share of buyers and lookers. And then it's just a matter of, does the vehicle fit the person's needs? And are they comfortable paying that much money and tying themselves up financially for 3, 4, 5, 6 years on that vehicle? And, Tesla is a known quantity. People know what they're getting. With a new car company, it's going to take time to establish and grow. It's not just going to be just price. It's still an expensive purchase. I think Herbert, we discussed that most people, between the time that they decide they want a new car and when they drive their new car off the lot in the US, it's like 7 days. So it's a very fast turnaround cycle. So people have to be kind of already know the brand, know the product line, kind of know what options they want. And then the decision gets made very quickly. So in order to get in that consideration loop, as the industry calls it, your brand has to be, widely known.
That's interesting. Yeah, thank you.
Yeah, my experience in the kind of the smartphone world was there was a point in time where our standards for Japan were much tighter than the US or China. And then at some point, the standards for China crept up and they actually were equivalent, in some cases even tighter, and they were building product equivalent to Japanese and US standards, at least from a fit and finish perspective. But what was always the underlying thing that wasn't solved was the operating system piece of it. And I think that's one of the other barriers to entry for the Chinese to go global is the operating system of the vehicle and being able to localize that software and have it have some sort of meaningful grip or some meaningful traction in new regions.
Introduce you to the only other person that I know of that agrees with you that China car companies won't go global. Jeff agrees with you, but most of us, hard to understand. But
I
Yeah,
guess
I mean, I think
look at how long it took the Koreans to crack the market, right? It was slow for many years, and then finally, they sort of became a reasonable option for a lot of American car buyers.
Plus,
Yeah.
add the tariffs and add the tariffs that the European now want to impose. I mean, all major markets are much more prepared for this third wave than they were for the Japanese or than they were for the Koreans, right? And there's just so much more
BYD
expansion of the.
just opened a factory in Hungary,
I
and
know,
these guys are going to
but that's
open
a battery
factories in
production.
Mexico.
But that's a battery production in Hungary. That's not a car production yet. So,
Okay.
I mean, I see them doing it. I'm following it closely in Germany for distribution partners, and it is tough. These distribution partners in Germany, they want real good money to take BYD on and to maintain those cars. Nobody was waiting for them. And while we always feel Tesla is not well treated by the press and by whatever, the European press is not kind with BYD either, right? So there is a. You're laughing, Nick, but it is. They're having a tough time establishing a good brand and finding a competitive price.
it won't be BYD this decade because of the manual nature of the way they assemble cars. They can go to Hungary or they can go to another country, but then their cost structure is going to be significantly higher if they take that manufacturing
How
process.
did they
and
show a
Shenzhen.
25% automotive gross margin a couple of weeks ago for Q3? I mean, I was sitting there, couldn't believe it.
Well, that's across all their vehicles. That's hybrid
Yes.
and EV. And we don't. I mean, I don't know how are these results. I mean, I guess they're real, but I don't know. They're not audited to the same standards. Let's assume they're real. I mean, you could get there manually, but then it's their labor and their cost structure in China, and that won't translate to Europe or the US. This is why I think this is going to be one of the barriers for them to go global is the software and is their approach to how they manufacture. Now, there are other Chinese auto manufacturers that are more automated, but it's going to take them some time. They've ramped their industry up pretty quickly, but now for it to go global, they're going to be able to have to adapt from a software perspective and from an automation perspective to lock into the cost structure of the region they're building in. It's not impossible. It's just going to take time.
And BYD cars are all with BYD batteries, or do they still source batteries from somewhere else?
I don't think they would be 100% in source. I think they would do some, but I'm not 100% sure. It's a good question.
There was a research that pointed out that the reason why BYD has high margins is because of their batteries. That's how they
because they probably take them at cost, right?
The way Tesla gets their high margins because of their software. That's and the batteries, of course. Okay, Nick, we've got a big question to ask you. The pullback by the automakers on their plans for EV, but I think you pointed out that Toyota is going to probably push really hard on their hybrids, and these car companies are going to push on hybrids, and they're going to just bash electric vehicles. In fact, I think we heard one today where there was like somebody on CNBC going, the electrical infrastructure is just not there yet in the US. You need to go hybrid, best of both worlds. What do you expect the auto companies are going to do, and how are they going to push their hybrids?
The short answer is the auto companies will do whatever the best they can, honestly. We have to remember that traditional car companies deal with a very, very difficult environment, both in terms of being able to predict future demand. So like we were talking about a recession, if we get a recession next year, demand goes down 10, 15%, which is a very, very mild recession in automotive speaking terms. And they've got to manage through that. They've got to still have some profitability to keep investing in the EV side. So I think the auto companies look at the next 12 months and think, okay, we're going to have a recession of some kind, some drop in demand of some kind. we don't want to sign up for multi-billion-dollar, incremental multi-billion-dollar projects. Let's use the technologies that we have to kind of bridge the gap, keep cash flow going, and see what comes out the other side. And I know it's a very, very short-term way to think about things, and very much sort of out of the tenor of our conversation, which is much longer-term potential. But over the near term, car companies think literally quarter to quarter. They think production schedules for Q1 and Q2. That's what they're planning right now. And so that's really the focus right now. However it is they get there, I think that they want to think long term, but over the near term, they've got several concerns about what the world looks like over the next 180, 270 days. And that preoccupies a lot of their thinking.
Do you think the UAW agreements, which obviously cost them a lot of money, influenced them to shelve certain EV projects? Was there a direct link, or was it just a coincidence that both things happened about at the same time?
It feels like a coincidence. The car companies think of the UAW as basically a fixed cost, and they try to manage that fixed cost as best they can. Sometimes they can. In the most recent agreement, they obviously couldn't. That was a big step up in pay. But they view that as something they've got to deal with, and it's kind of not part of the overall planning process in terms of thinking about where's CapEx going to go and how are they going to invest for the next 3 to 5 years. Those are kind of a fixed set of costs they deal with as best they can.
What's your personal opinion on hybrids? Because I just have this feeling that we're getting swamped with this idea that hybrids are suddenly the solution, which seems to be a solution for these OEMs because obviously, first of all, they're selling at higher prices. The consumer seems to be less reluctant for a big change, seems to, they sell it as if it is the perfect solution for all worlds. What do you think about hybrids?
I think hybrids are a step. They're a product. It's a product that a lot of more manufacturers have in a full EV product. And so, okay, they can push on those. I kind of doubt it's a gateway drug for the consumer to go all electric, though, because there's still this backup of having, an internal combustion engine involved in it. And so it doesn't feel like it's going to really accustom people to a full electric vehicle. I think the issue of charging, how many charging stations there are, charging availability, is an entirely valid concern. And, one thing I think perhaps is missed sometimes in the conversation of EV adoption in the US versus Europe is that Americans drive about twice as many miles a year as Europeans do. We tend to live in suburbs. We tend to live in areas where we have to commute to work by car. And the average commute is roughly 35 minutes. It's like 15, 20 miles each way. And so range anxiety is a bit more of an issue in the US than in Europe, where driving distances are fewer, where more people live in urban areas in Europe. Public transportation is more available in Europe. And so the US is a particularly tough market to crack. And so if hybrids are the near-term approach, so be it. It doesn't really, I think, address the fundamental issue of going all electric. And I think what the car companies are really struggling with right now is they've seen this drop off in demand over the past, call it 90 days, 120 days. And this is very unusual. If you're a car executive in this country, you're used to seeing hot products stay hot for a decade. If you look at minivans in the 80s, SUVs in the 90s, pickup trucks through the 90s and 2000s, 2000s, 2010s. When products get hot, they stay hot. And EVs didn't follow that profile, which must be very befuddling in Detroit because it's very against the usual process of how consumers adopt a particular vehicle line. And so they're kind of stuck right now saying, okay, if it's not EVs, let's try hybrids. It's kind of halfway there. We can get our CAFE numbers up using hybrids and kind of live to fight another day. But I think this sharp drop-off, I think, really came out of the blue for a lot of automotive executives, even though I think a lot of folks would probably have said it's pretty logical that Americans will be somewhat reluctant to buy EVs in mass until the charging solutions are really in place.
And do you think that applies to Tesla as well? Or is it just that all the other non-Tesla EVs that have this cliff?
Certainly the non-Tesla EVs have feel the cliff a lot more profoundly because they don't have that brand presence that we talked about. And because they're all run by car companies that are focused on a transition to EVs versus already there. So I think Tesla will be better off than most. It also has some more focus on cost, but I think it applies somewhat to all.
Nick, talking about hot products, have you heard of the Cybertruck? And curious what your expectations are. Dwayne "The Rock" Johnson was just on an interview with Joe Rogan, and he had no idea about the Cybertruck. So, given your background and knowledge of the auto industry and different car segments, do you expect the Cybertruck to succeed?
It's a really interesting product. I think its novelty factor is off the charts. I think from a design standpoint, super interesting. I think it will succeed, and I'll tell you why. Because one of the key products that saved Chrysler in the early 1990s was the original Dodge Ram truck, which went from being a very much of a lookalike product between the Ford and GM competitors to being its own beast with these very, very thick fenders that looked like an over-the-road truck, like a Peterbilt or a Kensworth, that looked really tough and kind of fit the design ethos of the vehicle as being a work truck. And at first, nobody thought it would work. People thought that was a too dramatic a design departure. The pickup truck buyers were very conservative, that they wouldn't buy this kind of very aggressive macho styling, but it really knocked the cover off the ball. So that market is available to people who take design risks. And additionally, the personal use pickup truck is a big thing in America. And so people will buy it just because it's a cool looking vehicle. I understand it's a very difficult vehicle to design, to build. And so it's going to be a little bit tough on that front. And I think Elon's talking about profitability being somewhat sketchy on that product for a while. But as a product that will be in demand, yes, I think it'll succeed.
Love it. Look at the background knowledge you have. And then I have to ask you the follow-up question, which is not a follow-up question at all. The Model 2, the Model 3 compact car is coming. And how important is it? I mean, obviously, many of us realize that having a compact car sub $30,000 is critical to just mass production and all that. But, your knowledge of what's happened to the industry, how big of a deal is this for Tesla?
It is a big deal. Small cars are really tough in this country, in America. Small cars sell very well in Europe and in Asia. The roads are narrower. People don't drive as far as I talked about. Smaller cars are a much more useful form factor. In America, small cars just don't sell very well because historically gas prices have been pretty cheap. And so who needs a small car because you don't really need the fuel efficiency? So the American consumer is not really super accustomed to buying a small car as a viable daily use vehicle. So it'll be interesting to see how it gets adopted here, how popular it is here. I think like with most of these products, it'll be hot for a year and then it'll kind of settle into a particular groove. But I think it'll be interesting to see how it sells internationally because that's really where it's going to take off. If you look at, say, the Ford vehicle lineup around the world, it's big trucks here, some sports cars, SUVs, but it's all small cars in Europe. So that kind of tells you where the demand's going to be.
So I'm sure you were not surprised that it will be produced as well in Berlin. So they're obviously trying it out in Austin and developing the line, probably Mexico, maybe India. Do you expect it to be produced somewhere else?
I think once you get a manufacturing process down, it ports over to different markets pretty easily, and you can take advantage of lower labor costs in other markets. So, I think it's smart to start production in a market that has a strong engineering and design ethos, and then you can port that process over anywhere else you want. But the core of small cars are a super tough part of the market anywhere in the world, but they're a critical part because ultimately you want that first-time buyer to come in and buy the affordable car. That gives you the chance to resell the car, to resell that consumer when they come back for their next car. About half of all cars are bought by somebody who owns that brand already. So brand loyalty is roughly 50-50, but you got to be in the game to get the first 50.
And if you upsell with software, right? I mean, if you have a recurrent income, it doesn't really matter at what price you sold the car and at what margin you sold the car because you'll have the recurring income from whatever FSD or any other services, right?
Yes, this is even before we talk about all the software add-ons. This is just the old school way of thinking about the auto industry. You want to have a full product line because you want to get the first-time buyer and then move them up the chain.
Now you have so much experience watching at this. Sorry, excuse me, last one. Watching this auto industry, do you feel the auto has moved to a software dominance now that they understand? Because I'm reading all these articles like, Chinese obviously get it more. The Chinese buyer wants software in the car. The Europeans are lagging it. Lots of people criticizing the European OEMs for not being as software driven yet. Do you feel this is the main tension at the moment from legacy to software?
It's a fascinating question. Yes, you're right. There's been so much pushback against the Europeans. Simple things like, okay, if you want heated seats, you have to pay a subscription. People hate that. When you spend $100 grand on a BMW, you don't want to pay $12 a month for heated seats. So there is some tension there. it'll be interesting to see how it evolves. But the software model for the established markets is just very hard to do unless you're offering new. If you've got a new service like self-driving, absolutely, you can charge $500 a month. But if you're charging for heated seats that have been in cars for 30 years, no, you cannot.
Sure, but then look at Volkswagen, who who already has the lowest margins among the German OEMs, and then their Carriot project. I mean, I don't know at what iteration we are, but stocking up thousands of IT people, firing them again, going all over again, changing it all again. I mean, I've hardly seen anything so painful as that.
Oh, unfortunately, I have in this industry.
True, right? It's a tough
But
industry. I
but
grant
but
you that.
but yes, you make a very good point. The industry has, that's the hard thing about the auto industry is that you can't do anything. Okay, I'll take this back. You generally can't do anything with less than 1,000 people across the board, any kind of project. The only exceptions have been when companies have their back against the wall. So, for example, Chrysler, out of desperation, had to basically fire half of their entire engineering crew in the 1980s, and the other half got stuck in the same building together in the early 1990s. And that produced very attractive vehicles that were easy to manufacture, that had good profit margins. But it was only after they had tried every other single thing and literally were at the brink of bankruptcy, where they literally had mortgaged their headquarter building in a bond in 1989, where they finally said, okay, nonsense aside, let's just try to survive. And then it worked. So as long as it's an irony of the industry, when you're well off and when you're a car company generating a lot of cash flow, you don't need to make those hard decisions. When you're back against the wall, then you have to, and then you do, and then no surprise, it usually works.
Now, I want to come back to something you said in my last interview with you, which really stuck with me, which is the way that other car companies conquered global dominance was by starting with the low price compact car. That's how Japan made it into the US. That's how decades later, Hyundai, Koreans did it to the US. Tesla did it completely opposite. They started with a premium brand, high price, and then now. So when the compact car comes, when Model 3 comes, it's going to just change the game, because you've also taught me that volume matters in the auto industry. The scale matters. When you have that many cars, the full thing. So, my understanding, what happened in the US was that because of low gas prices, then the Detroit 3 started to sell the SUVs and the trucks. But it's only because they did not decide, they let go of the small compact sedans and let it to be the Toyota guy. Because they don't make it, they don't sell it. And that's why the volume here is so low. But globally, the compact car and sedan sells like second to SUV, more than trucks. So yeah. I just think that the compact car is going to do very well. Tesla's car going to do very well in the US, but globally it's going to change the game for both the company and the industry.
Yeah, I agree with you about the international side. And this is kind of a legacy issue for this industry, because the difference between the US market, there are two differences between the US market and rest of world. The first is gas is really cheap here relative to the rest of the world, like a quarter the price in most developed markets and a lot of emerging markets as well. So we have very low gas prices. And like I said, we drive quite a bit more. And so we end up with consumers that prefer larger vehicles that are less gas efficient because they have to drive longer and a bigger car is more comfortable. And so the dynamic here is very different. Now, of course, when you overlay in electric vehicles, kind of the cost of gas becomes a non-issue because you're not paying for gas. And so you're left over with this residual consumer preference, which in the rest of the world, you're right, is absolutely focused on small vehicles for very pragmatic purposes. Smaller roads, less driving distance, smaller streets, parking regulations, a whole raft of things make small cars much more attractive, particularly in large urban areas, especially in Asia. In the US, it just isn't that way. And so I think you're right about what's going to happen in the rest of the world. But the US market, that's a tough call. You know, I've not seen a really, truly popular small car in this country. I kind of want to say since the first Civic, the first Honda Civic in the 1970s. And it was only, maybe the first Toyotas. Okay, so those two examples.
Bug, the Volkswagen Bug, the Beetle.
The Bug, but remember that
the Jeep.
There were three gas shocks between 1970 and 1980. The first one was in 70, which took prices from like 50 cents a barrel to $1, $1.50 a barrel. And then you went to $4 a barrel, which are kind of insane numbers, but these are the numbers, $4 a barrel in 1974. And then it went to $40 a barrel in 1979, 1980. And it wouldn't see $4 a barrel again until I want to say 1994. So that's kind of how chunky the moves in gas prices, oil prices were. And so there were periods of time when you got small car demand in this country, when gas prices took a shock higher. But in general, it just hasn't been a product line that Americans really have embraced for the last 30 years.
And Nick, I have another question is, you obviously are the expert in the car industry, but looking at Amazon and how suddenly AWS became the major profit bringer for AWS, how would you as a car analyst suddenly, understand or value or appreciate other revenue streams from Tesla? When would come the moment when you would say, oh, okay, I can't just use my car expertise. I have to now understand Dojo. I have to now understand a robotaxi network or whatever. When would that be part of your valuation process? And I mean, obviously, then having to enter different characteristics than you do when you do the other legacy automakers.
Yes. So let me sort of answer that two ways. The first is, one, you can do it like Adam Jonas does it. And I actually helped hire Adam at Credit Suisse to work in our European office, our London office. So he, I think, has figured it out and figured it out quite early. And kudos to him. He's a super smart guy. Loved him when I interviewed him. So
isn't that report from September? It's my Bible. I'm
Amazing.
reading it. I must be at the 10th iteration to read that.
So I think a guy like Adam gets it because he can think outside the box. He's a super clever guy. So kudos to him for figuring that out early and being pretty consistent, I think, and early in understanding that phenomena.
And bringing his teams from multiple disciplines, right? I think that's very important in that process.
Now, the second thing is any analyst can do this to some degree because the way you value a stock, just for sort of the listeners or viewers' perspective, in case you haven't had to do earnings models like a lot of us have, is valuations are driven by two things: how much money is coming in the door, and is it getting bigger or smaller, and then where's that money going? And the first thing drives near-term stock price movements. So if earnings are taking a decline, then stocks tend to decline. It kind of is that linear. But valuation, your PE multiple, is driven by where is the money going? What is the company investing in? And that's the key difference in a Tesla versus, say, a GM. GM still has to invest in internal combustion engines. Tesla does not. And there's really no broad-ranging comparison points. It's a very novel situation. So you brought up Amazon. It's funny because Amazon, Bezos said that Amazon Web Services was basically a wacky idea they had, and no one took them seriously for 5 years. It said the biggest gift in technology in the last 50 years has been that nobody took cloud seriously for the first 60 months of its life. And that gave Amazon this incredible runway to build Amazon Web Services before anybody else really figured out, oh, this is a thing, because nobody took Amazon seriously as they started that process. Fortunately, I think a lot of Amazon analysts were technology analysts, and so they understood the power of that computing platform. But I think, as you rightly point out, as an auto analyst, it's kind of hard to think about. It's easy to think about the units and the margins and the stuff that's coming in, the money that's coming in. It's super hard to think about where the money is going, where's the reinvestment process going, and what are the reinvestment possibilities that you get when you take $1 of automotive cash flow and invest it in a high technology product. That's super hard. So I understand why people have trouble with it, but I think Adam's done it right by pulling in a team and understanding what all those opportunities are worth.
Yeah, and that is true because especially this year, and I think next year still as well, most of the capex of Tesla is clearly prioritized to go into Dojo and to buy all these chips, while others are talking about plans and I'm talking about battery factories or I don't know what. And it just, I have the feeling we have crossed the street, but I just wonder when other people will join me other than Adam Jonas in that point that, I know it's still more than 90% revenue from cars, but you can smell it coming. You can just feel that there's something coming that's much, much bigger.
Yeah, but it's sort of like with like the Amazon story. Like how do you think about $1 that comes in because you sold a bunch of T-shirts online and then you plow it into Amazon Web Services? I think that's a hard concept to grasp.
I give
So
you
Nick,
that.
there was a lot of confusion when in an interview you said that you should think of Tesla as a stock, like an option play. You didn't obviously not say that it was an option call or anything like that. It was just that you're buying the stock, but there's a chance that one of these big things might happen. Bot finally happens, energy happens, robotaxi happens, and all of a sudden the value of the company will rise. That's what you refer to. So if I can, could I pin you down and you tell me, when do you think is Tesla stock today priced fairly? When will it hit 300? When will it hit all-time high over 400? And what's your forecast?
Yeah. So the beauty of what I do is I don't have to have a forecast because for my clients, they develop their own points of view. They're institutional investors. The process is what matters to them. And I've gotten a lot of feedback over the years that this construct of thinking as Tesla, or frankly, any company, as a combination of what they earn today, and that's worth something in the stock exchange, and then what is the market implying about future growth, and that's the second component, is a much more useful framework than PE ratios. So everybody complains about Tesla's PE ratio. Okay, it's 60 or it's 70 or it's 50 or pick your number. This is an irrelevant number. It just doesn't matter. And so as an investor, you've got to come to grips with what is expected today and what's expected in the future. And Tesla has a very high ratio of expected future value. And the conversation we're having right now is not so much about price, but about time. How long will it take to get to a certain point? And should you wait for that point? And to my mind, that's the conversation to have as an investor, whether you're the most high-end institutional investor or hedge fund or a small retail investor, is how much do you believe that these cash flows that are coming out of cars and getting reinvested in supercomputers, when is the tipping point when those businesses start making real money, have real impact? And that's what I worry about.
Currency. Yeah, time is the real currency. It's been my sentence for a long time. And that's the real advantage retail investors have. If a retail investor knows what money he needs in the next 3, 5, 10 years, time doesn't matter, and he just can clearly see the business model, adhere to it, be a fan of it, or whatever, put that into question, but also overcome, bad days and bad periods. But as an institutional investor, you have to justify your time horizon to your hierarchy, to your fund clients, to whoever else, to your board, and that's where time gets really much more tricky.
Yeah, and I'd say, I thought a lot about this, Herbert, after our last conversation. I thought, why does this company have so much credibility? Because that valuation says it has a lot of credibility on a bunch of things that, let's face it, are in the future. And not just in the future like, it'll take another 5 years to build electric vehicles. It's in the future like we're going to change the way people drive, or we're going to use supercomputers in new ways, or Gen AI is going to be a transformative technology. And to my mind, as an industry analyst, it comes down to two things. First, that Elon Musk and the Tesla team made a car company work at scale. This was not, 5 years ago, this was kind of a kit car company. And now it's a real, large, structurally important car company. And I think as an auto analyst, I look at that and say that is truly impressive. And the second is having a multiple vehicle lineup. That is equally impressive. So the combination of those two things gives the company a lot of credibility.
I have a question, Nick, if you're okay with that. Would you mind explaining to us what your business model is? What is DataTrek? What are your type of clients, and what do they purchase from you? Is it all the daily newsletter, or is there consulting? How do you survive? How are you able to put this all good information out there?
Yeah, it's a super simple business model. I learned from the auto companies that you don't want to do a lot of things. You want to do one thing. And that is, I sell a daily market newsletter. It has 3 sections: a discussion of markets, a discussion of some data points that are relevant today, and a discussion of disruptive technologies. Because I thought that, particularly when we started the business 6 years ago, the concept of disruptive innovation was kind of in the atmosphere, but not really pinned down and discussed very well. So it's a daily newsletter. We charge by the month or by the year. It's $100 a month, $1,200 for the year. And we have customers, and they give us our credit card, and we make money.
And it's mainly institutional, or can I know I subscribe, but can retail investors subscribe? You don't have a limit where you say, I don't want retail investors?
No. Anybody with a credit card, a valid credit card.
That's good. We all do have that.
Good business model.
What car do you drive if you drive a car?
I do have a car. I've been a Porsche fan for a long time.
Oh,
and I have the last year Macan Turbo.
Okay,
'Cause,
perfect.
yeah,
Any
Nick
any
lives in
plans to go
Manhattan.
into
Yeah.
EVs, or you're not yet on that EV train?
I hold my cars a tremendously long time, like 10 years plus, 100,000 miles plus. Um, and it's my way of trying to be a little bit responsible because let's face it, driving an ICE vehicle is not a particularly responsible thing to do. And I live in New
Mhm.
York, so I don't really need a car all that much. But producing a car, any car, EV or ICE vehicle, is also creates a lot of pollution. So if I hold my vehicles a long time, I'm doing a little bit to help. I also live in a very small apartment, and try to be responsible in a lot of other ways. But yes, I do still have an ICE vehicle.
Okay.
So your institutional investor customers who subscribe to your newsletter, and you're very connected to these guys, how do they see Elon as number one, as a key man risk, but two, just his behavior that he's doing? Does that prevent them from investing in Tesla?
I think it does. I think honestly, the key man risk is probably a more important issue to an institutional investor than any kind of behavior that people might find untoward. It's hard because it's very hard to know how much of Tesla's valuation is responsible is due to one person's vision and communication ability and kind of wide ranging effect on disruptive technology. It's just very hard to know. Like I once had a conversation a few years ago with an investor who said, "Okay, I want to own Tesla for a long time, but I'm buying 100 strike put options on every quarter because on the off chance something happens to Elon, God forbid, I need some downside
Mhm.
protection, and it'll be explosive downside protection." So people do think about that risk and how to hedge it. I've never heard anybody say I will never own the stock because of Elon. I've heard people say, well, I might have to think 3 or 4 or 5 times and really pick an easy spot to buy the stock. Like we had a lot of folks at the end of last year who bought a bunch of these tax loss selling tech stocks, Tesla among them, and did very, very well this year, obviously, but they'll be more selective as to when they overweight the name.
Mhm. Yeah.
I've heard some people say that if something, God forbid, happened to Elon, it would be a 30% immediate cut, but that's about it.
Decline.
What's any guess on your side? What do you think the impact might be?
None whatsoever. No guess. Like I said, I just there are some folks that try to play this with some options. You can and the funny thing about an option is you can be wrong on the level and still right because volatility explodes. So you don't necessarily have to pick the strike exactly right. You'll have some downside protection if all of a sudden the stock opens up down 30% one day.
So that's actually another question I had. Tesla still has a high bidder above 2, I think 2.2 or something like that. Do you think that as long as retail investors have at least as much as institutionals, this will stay a volatile stock? Just doing its own game, as you've proven with your correlation analysis.
Yes, I think it will because of the option valuation we discussed. Tesla's
Mhm.
round numbers, half a we're going to make it to the other side car company, make it to the EV transition because obviously, they've got the product line, they'll make it. So that's kind of a lock. And then the other half is all the other technologies that the company is working on. And the thing with options is that they're more volatile than underlying stocks. So I don't see that changing anytime soon. It's going to be just the price of entry for this stock.
I just want to let you know, you're now responsible for my sleepless night, because in the interview with Herbert, you said, well, as a Tesla investor, when you wake up at night and you ask yourself, will it be, autonomous drive? Will they get there? So every time I wake up at night, I said, oh, Nick said I have to think about that. And I think about it and I fall asleep again. That's on you.
Hey, well, you can sleep, so you're fine.
I do.
Wonderful. Thank you so much, Nick. Love it. We have so many more questions, but we did promise to keep it to this short today. Folks, you got to follow him. DataTrek Research. He sent me a few of his newsletters. Alexandra subscribed already.
Subscribe. It's good stuff.
It's good research. I mean, it's unbelievable. We shared a little bit today.
Money. Yeah.
Well worth it. Thank you so much, Nick. I really appreciate your bring us to the institutional investors, but also your auto industry. The two together is rare. And we're going to get you to break out of the auto industry and you're going to start looking at everything else the way we do. But you're a bull. You're a Tesla bull. So we just have to make sure we get that out. Thank you so much, Nick. Appreciate you.
Thanks a lot.
Thank you so much.